We've got some great speakers this morning. We have God's Will in Wonkwo. I'm probably butchering that, I'm sorry, of Bedford, who will be speaking first. We have Ken Piddington of Compass 42, who will be coming along shortly after, and Katie Minert of Ally or Pink Petro coming afterward. The speaker we had last, so I'm going to be bringing God's Will up here shortly. He serves as the president and CEO of an energy-focused private equity and project finance company. He currently works with his team and affiliates to build and deploy sustainable operational and financial strategies that are geared towards growing value in the short term and long term. These often include providing contract turnkey drilling, which minimizes the risks and uncertainties of time and cost, as oil field wells can be planned, drilled, evaluated, and completed to the client's specifications. God's Will has previously worked for Schlumberger, Halliburton, Baker Hughes Intech, and several national and multinational companies. Excuse me. God's Will has a bachelor's degree in mechanical engineering with a specialization in computational fluid dynamics, CFD, a master of science degree in computer science, a specialization in cognitive artificial intelligence. That sounds awesome. And an MBA in finance with specialization in private equity and investments. God's Will is also a candidate for president in Nigeria.
Hello, good morning, everybody. I'd like to welcome everyone this morning. But before I start, I'd like to thank Tommy San Miguel. I also like to thank Craig Hicks, Bad Borsen, and the rest of the investor relations team. But most importantly, I want to thank the SGR Energy for bringing us here today. Today, I'm going to be talking about the returns optimization strategies in upstream assets. We'll offset production from new well in the first half of 2021. And so as new wells begin to come online later in 2021, maybe the second half of 2021, the production will now exceed the legacy well declines. And legacy wells are the wells that are already in place that had not been added to the population. And this resulting in an increased crude oil production. So previous price collapse are usually followed by industrial rebound and then business as usual, and then life goes on. But this time is truly different. Why? Because we have so many things happening at the same time. One, we have a supply shock with an unprecedented demand drop, which is accompanied by humanitarian crisis. So without these changes, without making the structural changes required, the industry could be entering in an era defined by intense competition, flat to declining demand, investor skepticism, and increasing public and government pressure regarding climate change, building optimal asset allocation. And this optimal asset allocation, you benchmark this allocation using the Sharpe ratio, which is the RVOR, which is a measure of the reward to volatility ratio. And of course, use another second tool, which is the Trenor's ratio, which is the RVOR, which is a measure of the risk premium per unit of systematic risk. This is implemented using a risk matrix from reserve classification. And reserve classification allows you to now define the risks for both the proved reserves, the probable reserve, and the possible reserves. And when you assign those risk matrices, you'll be able to now generate a model that would allow you to now continuously revisit your portfolio to make sure that you have the optimal portfolio at every point in time. Now, the managed portfolio also allow you to create hedging strategies, and you can use several hedging strategies, including forward contracts. The benefits of the managed portfolio is it involves building and overseeing portfolio. It allows you to conduct research, which of course is demand and supply forecasting. And of course, it allows you to benchmark performance. But most importantly, it allows you to incentivize the management team, because you can set PIPs, which is performance incentives, and ensure that you incentivize them to give you better production. Now, this is a screen capture of one of the assets that we're looking at a couple of months ago. This is an asset that was in Texas. We plugged everything into our model, generated the matrix, allowed us to draw the forecast, and we came up with the valuation using our discounted cash flow to about $50 million for the valuation. Now, if you look at this particular asset is the target of return for this asset is about 28%. So that means that it falls within the medium risk. So we run all our assets and we vet all our assets through several of our models and several of these systems that allows us to classify those assets and ensure that they are actually delivering the returns that we expect. And with that, I'll open for questions.
Yeah, I saw that it said on one of the slides that you were either going to divest, invest, or retain, but retain should be a conscious decision rather than a convenient one. How do you enforce that?
So we know that in the oil and gas, we have the tendency to withhold dividends from shareholders. I mean, they believe that they have to reinvest, the net income. So the payout ratio, they try as much as possible to reinvest, to retain 100% of the net income. But that is not the strategy if you want to create that capital gain for your portfolios. You have to be able to, ensure that you provide that dividend distribution to your investors. And if there is any reason for you to reinvest those retained earnings, you have to be able to demonstrate that it will actually generate the required amount of return that the investors will be comfortable with. Because, and I can tell you this because it has happened so many times, in my experience, my 20 years experience in oil and gas. Operators are always hot about the new thing out there, without any concern whatsoever on how much value and how much net present value is going to bring to the company or to the entity. So that's why we're creating this broad, robust model that would allow us to benchmark every decision we make. If we have to retain some of the earnings and invest them in, let's say we probably want to buy a new technology, how is that technology going to generate extra returns for the investors? We have to be able to demonstrate that. If we can't demonstrate that, first of all, we have to look at the NPV and the IRR. Of course, that's basic in terms of capital investment decisions. But we have to be able to ensure that the investors are comfortable with the idea that we are getting $10 million NPV versus $20 million NPV. And we have to demonstrate that. If not, we should distribute dividends, because distributing dividends automatically creates that capital gains that investors are looking forward to exiting with. And it also raises the value of the entity. So we are trying to kind of create that mindset where we drive more distribution of dividends to shareholders. What play and what portfolio you want to invest, and you invest a little at a time, and you create that diversification so that at the end of the day, if you want to invest $1 million, you're not going to see a total loss. The chances of having a total loss for your $1 million will be very slim, because at the end of the day, if the one in Premier comes out dry, whole, the one in Backend or the one in Ego Forward is going to come out with production. So we want to create that diversified portfolio that would allow investors to at least get away from having a total loss.
Okay, so the question that came in says, when you say that you can help raise capital, can you clarify? Yeah, when you say you can help raise capital, can you clarify in more details how you do that? Does the client have to have an asset, or can you help raise capital pre-getting the asset?
Okay, so we have several strategies to raise capital. First of all, we have the fund where I showed you let's go back real quick. Okay, so we have this situation where we have the fund, we create the fund, we have the low risk fund, the medium risk fund, and the high risk fund. And that investment fund can be used to acquire assets. But before those assets are acquired, we have to pass them through our proprietary vetting system that allows us to run them through our matrix, run them through our risk matrix, run the reservoir economics, and be able to see where to classify those assets. If it's for example, the one I showed you, if it's a 28% internal rate of return, that falls into the medium risk bucket. And that is the bucket that that investment or that investment capital is going to come from. So we're going to, if the person asking the question has an asset that they want to sell, we run it through our proprietary system that I've described, run it through the risk matrix, figure out, okay, what is that rate of return is that particular asset? And we put it in that bucket. Whether it's an Ego Ford, it's a backing, it's Marcellus, falls into that bucket. And when it comes for capital investing, we now acquire those assets and bring that asset into our portfolio.
Anybody else? God's will. Thank you very much.
Thank you.